Okay, here we go. Let's do resident training. All right, so here we are. We're going to talk about some of the same things that we talked about in the non-resident side. We're going to do for the resident side. We're going to do credits. We're going to do education benefits, which are a really big one for our clients. And then talk about finishing the return. Depending on how much time we have, we'll either do another little tour of TaxSlayer and do some Dear Iris questions. All right, we're going to do that. We're going to do that. Okay, so a couple things on the resident course. So I do add people to the resident course based on their volunteer data questionnaire. It's not really a quiz. So we've got 5 modules that are basically should be done so far. They're all essentially quizzes, no real assignments yet. I would say generally most people are doing well on them. The filing status tends to be kind of the one where people have struggled the most. I really strongly encourage you to use your 4012, the flow charts and the tables to like figure out, answer this, yes or no, continue, not continue. That really does. It's a little painstaking to get through those, but those do really walk you through how to determine those things properly. The one thing I'm going to remind you all, right, is that we don't expect you to remember everything off of the top of your head for this, particularly for the resident taxes, right? It is way too much information for you to remember. What we really want is for you to be comfortable and efficient at finding the reference information that you need, either in the 4011 or from other trusted resources like the IRS website, not Google or ChatGPT generally. All right, so a quick review of 2 weeks ago, right? This is our general tax equation. Lots and lots and lots of types of income, right? But we're going to see wage income. We're going to see scholarship income. We may see a little bit of dividend or capital gain income from people that are doing stock transactions. Hypothetically, there might be a little bit of business income for people that are interns that work and get a 1099 rather than getting a W-2. Generally, the summary is, right, for residents, TaxSlayer is your friend. It's very frustrating, right? It's not very good for non-residents, but for residents, it's intended for them. So if you have the proper income document, you get it into the tax return, into the software, generally it's going to treat it properly, or it will once it's gotten through the whole validation process for the 2024 update. There is a long list of adjustments, right? A lot of these, or some of these people that are non-resident aliens are eligible for, other ones they're not. Almost all of these, again, will have an income document. There will be some of them that we'll see, things like the 1098E. Sometimes it'll be receipts. Again, get that information in there. TaxSlayer is generally going to know how to do the right thing with that. The standard deduction, right? Set dollar amount that reduces the income. For this, almost everybody can take the standard deduction. Generally, only people that are married filing separate. If one spouse itemizes, the other one has to. Otherwise, people can take the standard deduction if they want. Itemized deductions are very uncommon now because of those changes in the tax law. Theoretically, state income tax, property taxes, home mortgage, medical expenses, gift to charity, those things all could theoretically get included as itemized deductions. Usually our clients, right, college students, they're not going to have a lot of those things. They're not going to own a house. They're not going to have a mortgage. They're probably not going to earn a lot of income, so they would have a lot of state tax paid. So we're not going to see a lot of this for Schedule A. All right. Any questions on those before we jump back and start moving forward on resident returns? Okay. All right. So when we talk about credits, we're going to talk about 2 kinds, non-refundable and refundable credits. So non-refundable credit basically is a dollar for dollar reduction in the amount of tax that you owe. However, a non-refundable credit can only take your tax down to 0. It's never going to actually give you any money. It only takes your tax down to 0. Taxpayers with no income tax don't benefit from claiming any non-refundable credits, because if you don't have any tax, you're not going to get any money back. You're already at 0. It doesn't take you down any lower. Generally, they're going to be applied on the order that they're listed on the 1040 NR, and then a lot of these also show up on the Schedule 3 is where they would show up. So just an example for how this works. So let's imagine Chris has federal income tax that he owes of $470. He meets the credit requirements to claim a $500 credit for other dependents and a $100 retirement savings credit. The total amount of his credits are $600, which is more than the tax that he owes of $470. So he uses those credits to reduce the tax down to 0, but that $130 of extra credits, it basically just goes away. It doesn't do anything for him. He doesn't get paid for a refund. It doesn't help him in any way. It doesn't carry over till next year. It's just done. But he doesn't have to pay any tax, so that's great. All right, some of those non-refundable tax credits, the biggest one is the child tax credit. So it is non-refundable. It's a maximum of $2,000 per child. If you can't use the maximum amount for non-refundable, there is a portion of it that is refundable, and they call it then the additional child tax credit. There's a form 8812 that's used to claim this credit. It basically collects a little bit of additional information about the eligible children to determine the credit. Their age, they have any income, they're in school, that kind of thing. All right. To be a qualifying child, you must be a dependent and you must meet the following requirements. So the age requirement is be under age 17 at the end of the tax year. Again, that US citizen, national, or resident alien. There's a relationship test. You have to be claimed as a dependent. You can't provide over half of your own support. You must have lived with the taxpayer for more than 6 months, although there is an exception for temporary absences like education, going to school. And then you also must have a valid Social Security number. There are a couple of special exceptions for divorced or separated spouses. When you have like the legal documentation for one spouse to claim the person even if they're not living with them. To be a qualifying child for the relationship test, the way that I think of it is like your level and below. So like your sibling, your children, your siblings' children, half siblings' children, but you can't go up to like your parents or your aunt and uncle or somebody where you go up your aunt and uncle down through cousins. It's got to be your kind of level on your side of the family there. All right. There were some significant changes in 2021 due to the pandemic. Those changes have basically ended. It was a very large credit for 1 year, but it's back down to 2,000. The amount that is refundable, though, does continue to increase over time. So for 2024, the refundable amount is $1,700. However, to be eligible to claim this credit, you also have to have earned income of at least $2,500. And they don't give this money out in advance. The only way you get it is when you file your tax return. All right, if somebody doesn't qualify for the child tax credit, they might qualify for the credit for other dependents. Again, this is a non-refundable credit. It is smaller, it's only $500. If you meet the criteria to be a child tax credit, then you have to use that one. You can't use this other dependents credit. But they can be a different relationships. They can be a qualifying child or a qualifying relative. So if you go back into that 4012, there's that list of what does it take to be a qualifying child? What does it take to be a qualifying relative? The list for qualifying relative can be used for this. In addition, that child can have an ITIN as well as a Social Security number. So we see this quite a bit for individuals that are here. They've been here long enough to become resident aliens. And now the primary visa holder, the spouse on the -2 visa, and the child on the -2 visa They're resident aliens. They get ITINs. The spouse and the primary visa holder file a joint return. They claim their child with the credit for other dependents on their tax return. So that is relatively common to see. All right, so an example, Francine is aged 43. She earned $43,000. She supports her widowed mother-in-law, Connie, whose only income is Social Security now, and then her son, Henry, and Neil, ages 16 and 12. They all lived with her in Chicago. Her sons don't provide any of her support or their support. So everybody has a Social Security number except for Francine and Henry, who both have ITINs. So who can Francine claim for the credit for other dependents? So she can claim Connie because she is her dependent under the rules for a qualifying relative. She's not a qualifying child because of the age and relationship tests. Henry, she can claim him because he qualifies as her dependent for that because he's an ITIN holder, not a Social Security holder. He's not eligible for the child tax credit. For Neil, he can't be claimed for the credit for other dependents because he's a dependent, because he has a Social Security number. Francine has to claim him for the child tax credit. All right. All right. The next one is the credit for child and dependent care expenses. So the idea behind this is if somebody, a taxpayer, has children and they pay somebody to look after their children while they work or while they look for work, they can deduct that or count part of that money as a credit on their taxes. It's based on a percentage of the expenses that they pay, and that percentage is determined based on their adjusted gross income. So the maximum you can claim if you have one qualifying person is $3,000. If you have two or more qualifying people, you can claim $6,000. The expenses don't need to be equal as long as you have more than one person. So if you have one person with 4,000, another person with 1,000, and another person with 1,000, you can still claim that full $6,000, even though it's not equally spread among the three people. There are some other limits. There's a smaller age limit, so they must be under 13 years of age if they're a child. If it is a spouse, they must be unable to provide self-care, or another dependent of any age who is also unable to provide self-care. So which generally means they can't be left alone. They have to have somebody with them. This is prepared on Form 2441. It collects the expense amount and it fills out the credit information. When you do this, the child or the person that you're claiming has to meet all of these requirements. They must be a qualifying person. They must have earned income. They must have work-related expenses. So going to school does not count as work. It has to be actually working or looking for employment. If you are married, you must file a joint return. And then whoever you are giving this money to look after your child, they have to provide their name, their address, and then a tax ID number. If they're a person, it needs to be their Social Security or ITIN number. If it is a business, then we need their business employer identification number. So we're starting to get into some of the credits where the IRS gets a little bit more grumpy about making sure that all of the information is there because it's easier to cheat. And so they want more documentation and more information to make sure that only eligible expenses are used, right? Because at this point they're saying, okay, you're reporting that you paid, Sunshine Daycare $5,000, and somebody else is reporting and somebody else is reporting. The IRS can use that and say, all right, well, Sunshine Daycare said they had no income. But all of these other people are saying, yeah, but I gave them all this money. They're going to say, okay, Sunshine Daycare is not filing their correct tax returns, right? Because lots of people are saying they give them money and they're not saying that they get any. All right, we're going to skip this for time purposes. Credit for the elderly or disabled. We probably won't see a lot of these, but it's theoretically possible that we would. Basically, it's a non-refundable tax credit that reduces the tax burden on individuals who are elderly, which is defined as over age 65, or on total or permanent disability. If they are not over age 65, they're going to need a physician's statement. They don't have to send it in with their tax return, but they need to have it so that they can provide it to the IRS if they get asked. There is a special form, Schedule R, that's filled out, determines the eligibility, and calculates the credit amount. I'm not going to worry about that. Retirement savings credit. This one again is if you're saving for retirement. That's a great idea, right? Remember, we've got 100 years of social engineering at work. We're saying, yes, please save for retirement. We'll give you some money off on your taxes. So that's what this one is. It's also called the Savers Credit. The couple of really important things on this, right? So you have up until the point that your return is due to make a contribution to a qualified retirement account. So that means if you wanted to, you could like do your tax return and then put in a contribution and say, hey, does that give me any money? And then you could do that if it's good and not do it if it doesn't give you any extra money back. Totally fine, totally legitimate. People do that all of the time. To claim the credits, you're going to use Form 8880. There's a spot in TaxSlayer where you can enter your retirement contributions. If you do it through work, it'll be on your W-2. One of the codes in the box is going to do that. To qualify for this, you have to be older than 18, which is not going to be a problem for most of our clients, but you also cannot be a full-time student. So that probably is going to cut out a lot of our clients. We probably could see some that would qualify. That'll generally be people that are here as like a postdoc researcher or a teacher rather than a student. This person that claims it, they also can't be claimed as a dependent on another person's tax return. And there are some income limits as well. Probably won't be an issue for our people. Basically, for retirement contributions of up to $2,000, you may get a credit of up to $1,000 that reduces your taxes. Remember, still non-refundable, but it's going to reduce your tax. If you're married filing joint, it's going to be double the amounts, up to $2,000 of a credit based on a percentage of your contributions. And the percentage is going to vary based on your income and your filing status. So TaxSlayer, when it's working, will do the math for us to say like how much that credit is going to be. But it can be a really good incentive to save for retirement, right? But you have to meet the criteria for it. This is a list of the retirement accounts. If they work at a company that has it, they would have it listed on their W-2. This one is on box 12B, but it could be any of the letters. So there's a whole bunch of different codes where the employer reports various types of things that go into box 12. There's a bunch of different types of retirement accounts that they would potentially be able to contribute to and be eligible for from that perspective. Okay, so that is non-refundable credit. So they reduce your tax down to zero. They don't give you any money back. Let's talk about the good stuff, the ones that actually put some money in your pocket. All right, it's considered a payment made by the taxpayer. It will actually get you money back. Even if you don't have any income tax that's owed, if you're eligible for a tax credit, you should 100% file so you get that money back, right? I won't say this is free money to anybody, but right, if the government is going to give you some money back, let's by all means make sure you're eligible and get it for you. So in this example here, we'll do another one. So Jeremy has federal tax of $2,600 that he owes. He can claim a $2,000 non-refundable child tax credit and a $1,500 refundable earned income tax credit. The total amount of credits is more than his tax, 35 versus 26. He gets the full amount of the child tax credit, which reduces his tax down to 600. Then he applies that earned income tax credit, takes that 600 down to zero, and then pays him the rest of that, the $900 in cash is what he gets back. So And the earned income tax credit can be a very valuable, very important credit for many low to moderate income families and individuals. So if you claim the child tax credit, but you don't have $2,000 worth of tax that you owe, you may be able to get a portion of that as a refundable credit, which is called the additional child tax credit. 1,700 of that 2,000 is now refundable. The same qualifications apply, except that you must have, again, more than $2,500 of earned income. To claim the credit, you again use that form 8812. TaxSlayer will do the math to say which part is refundable, which part is non-refundable. The main thing that we would be doing is making sure that all of the dependents are entered properly. I'm going to skip that because we're a little short on time. The earned income tax credit. So this is the big one, right? So it basically provides income, additional income to people with low to moderate incomes, particularly people with children. So people without children can qualify, but the amount of income that they can earn is quite small. Whereas those, if you have more children, the bigger credit you will qualify. So there is a Schedule EIC, which basically collects information about the children. And then based on your income, your earned income, in fact, the software will calculate how much that tax credit is. Unfortunately, because this is a refundable credit that is available to low to moderate income individuals, this is also an area that has been subject to fraud in the past. And so the IRS definitely is concerned about that. So they want to make sure that they have the correct information about the dependents and that the correct income information is being reported to make sure that somebody is properly claiming the credit and is not falsely inflating or deflating their income. If somebody was naughty in the past and they IRS said, hey, you have a W-2 that says you earned this much, but you said you only earned this much. When we do the math, we say that you don't get this credit anymore. If it was previously denied, there is a special form that they have to fill in that says basically why I'm reclaiming it now and why was it reduced. And I promise, I swear I'll never do it again. Please forgive me, I was bad, my fault. All right, the credit. So based on the number of children and what your filing status is, there's an income limit for how much you can earn and a credit maximum amount that you can receive. So if you have no children, your maximum and you're single, the maximum you can earn is $18,591, but you would potentially get an additional refund or credit of $632. If you have a child, that income number jumps up to $49,000 and you can get $4,200 potentially of income, of credit back. And it's going to be ratioed based on your total income. So it's not you earn the maximum, you get the maximum back, but that's like the maximum. 2 children is big, 3 children or more, $7,800, right? So it's pretty significant amounts of credit when you look at that from a percentage wise. So it's a good thing for all of the people that we can get it for. So to qualify, they have to have earned income. They have to be a citizen or a resident alien for the entire year. They have to have a valid social security number, as well as for themselves, their spouse, if they're filing a joint return, and any qualifying children. They cannot have more than $11,600 in investment income. They cannot file separately unless they lived apart for the last 6 months. They can't file Form 2555, which is a foreign income form. And if they have no qualifying child, they must be at least 25 years old. And they can't be the dependent of another person. So a lot of the students that we help will not be eligible for this. Even if they can't be claimed as a dependent, a lot of them are going to be under age 25. And so they are not going to be eligible for it. Good thing for us, the software is going to do that automatically. They're going to put their date of birth in there. It'll do the math to say, oh, sorry, you're under 25. It'll knock you right out of it. It won't even ask any questions about it. There is an exemption for that. I think you would get it here. Well, for the child to qualify you for the earned income tax credit, basically, again, kind of your level and down, right? Your son, daughter, their children, their children's children, or your brother, sister, your level, and then down from them, nieces or nephews. The age, they either need to be under age 19 and younger than you, or younger than you and I'm under age 24 and a full-time student, or any age and permanently and totally disabled. They must have lived with you again. Can't file a joint return for the year. Earned income is income that you receive for work. So if you have investment income like interest, rental properties, dividends, capital gains, pensions, all those things don't count as earned income. They do explicitly define it as W-2 income as well as net income from any sort of a business. So if you are self-employed, have your own business, that would definitely count as well. Sometimes union strike benefits will qualify. I would be incredibly surprised if we saw any union strike benefits in one of our clinics, but theoretically that's possible. These other types of income also don't qualify, such as alimony or child support, unemployment or workers' comp, inheritance, gifts or gambling, investment income, or pensions or annuities, right? So we're really generally looking for wages, or we're looking for somebody that has their own business. Excuse me. Okay, premium tax credit. So through the Affordable Care Act, right, which was the legislation that required people to have health insurance, they established the premium tax credit. The idea being, if you are low to moderate income, you need to have health insurance. Based on your projected income for the year, we can give you a credit for how much you're going to have to pay on your health insurance. Then at the end of the year, you basically have to reconcile that. You say, oh, I think I'm going to earn $20,000 this year. And they say, great, that's not very much. So we'll give you, $1,000 to help pay for your insurance. And then you get to the end and you say, oh, it was a great year. I earned $30,000. They'll say, yeah, but now you have to pay back some of that premium because your credit is not so big because you earned a lot more than what you said you were going to get. So anybody that would have to do this would have to have an advanced certification. Everybody's doing that through our program, so that part is not a problem. The insurance that they have must be purchased either from a federal health insurance marketplace or a state-based exchange. Generally, the students, scholars, teachers, and researchers we help will have insurance through the university, not through a marketplace. But if it was somebody from outside of the organization, then they could potentially have that. This is that kind of same point that I went through, same scenario. So to qualify for the premium tax credit, they can't be eligible for employer-sponsored health coverage. They have to purchase it on the exchange, federal or state exchange. Their income has to be within 100 to 400% of this poverty limit, which is based on the area they live and their family size. They can't use the married filing separate status unless there's an exception for spouse abuse or abandonment that would apply. Those 100 to 400%, those are all going to be in the software. We're not going to have to worry about calculating those. If somebody buys insurance through the marketplace and they get this premium tax credit, they should get a 1095-A form. 1095-B forms are for employer coverage, and 1095-C, I think, is for the university or nonprofit coverage. So the letter, that 1095 says it's a health insurance, proof of insurance form. The letter is important, saying where they got that insurance from. The form A8962 is used to figure the credit. It basically captures that information. on their form, and then whether they should have paid more or whether they got too much for that credit. Generally, that 1095A is not going to be something that we see in our clinics. I think I've seen like 1 or 2 of them over the course of the years. But if they do, we're going to basically be entering that information in on the form, and the software is going to help walk us through determining the credits, if there's anything that they need to enter or pay back. What you're going to look for is like, is there any inconsistency in the form, right? Do they say on the form that, like the insurance form, that it's just them, but on their tax return, it's themselves and their spouse and their children? Or is it reversed, right? Themselves, their spouse and their children, but only themselves for insurance. Try to make sure that their information is consistent between the documents. And we're gonna skip that one, we're gonna skip that one, because we want to talk about this one. So this is the biggest one for us, which is tax benefits for education. All right, I'm gonna skip that. So basically, the government says, yes, we love educated people, go to college, we will give you money off on your taxes. All right, there are 2 main ways, 2 main credits that people can get for education: the American Opportunity Credit and the Lifetime Learning Credit. You can only take one of those for each student. However, if there are multiple students listed on the return, they can have different credits that they take. So one student can take the American Opportunity, another student can take the Lifetime Learning. There are other benefits to look out for. Sometimes people have qualified tuition plans or employer benefits. There can be scholarships and fellowships that will pay for college as well. We're going to talk about some of those here. All right, so we've all talked about scholarships and fellowships from the non-resident perspective, right? That same first to last criteria apply. If they have a scholarship or fellowship, if they are a degree-seeking student from a qualified educational organization and it pays for qualified education expenses, and that is going to be non-taxable income for the students. If it pays for anything else, that is going to be considered taxable income. If somebody is paying out of pocket, either for tuition or room and board, well, not mostly for like tuition and fees, other required expenses, they may be able to get a credit for some portion of those expenses. All right. Generally, the school will provide that 1098-T form for residents. So, and that is kind of, I won't say that it's 100% required, but it is a little bit suspicious if they don't have one, right? Why did the school not provide that? Does the school think that they are non-resident aliens still? We should probably check to make sure that they are truly a resident alien. Does the school think that scholarships paid for everything and so they don't have anything? I mean, like, why is that form not there? There can be very legitimate reasons, but it's worth another question or 2. There are a bunch of questions about this on the form 13614C, which is the intake form. Because we're an FSA site, we don't do that formal interview. We're gonna just rely on that general discussion when the student has a question or when the student wants us to review their return. All right. I'm gonna skip these, right? Eligible things. We've already talked about qualified education expenses. Those are generally the same. It's not going to include like room and board, health insurance, transportation, parking, research, travel. Basically, unless it's required for enrollment in the class or required for enrollment at the college, it's not going to qualify as an education expense. We've talked about scholarships. This is what the 1098-T form looks like. Basically, it's going to have the school's information, student information. Box 1, payments received for qualified tuition and related expenses. And then box number 5, scholarships and fellowship grants. It is very possible to have numbers in both boxes, so they don't zero them out. So if you get a $5,000 scholarship, but you paid $10,000 in tuition, they're going to show $10,000 and $5,000. They're not going to just net it out to show $5,000. This is not always enough information to calculate credits correctly, right? Sometimes it can be, but often there are other expenses that the students pay for that are not going to be listed on this because they're not paid directly to the school. Sometimes the schools may not send that form again, right? Maybe the school thinks they're a non-resident alien when they really are a resident alien. It can be a challenge. So if they have additional expenses that are not on this, that's totally fine. They would need to have some sort of documentation for them, like receipts from the bookstore, that kind of thing. That's all good. We'll generally take our word for it as long as they're reasonable, but they would need to have those in case the IRS asked for documentation. All right. Student accounts are another really good place to get information. So the 1098 is one summary number, but that should theoretically be built from the student account transactions. So you can go back into that to try to look at what did the student actually pay. All right, let's talk about the credits here. So to be able to claim an education credit, a person cannot be claimed as a dependent on another person's tax return, right? So that is a big area of, I don't know if dispute's the right word, like tension, right? College students want to claim the credit, get $1,000 back on their return. Parents want to claim the credit, get $2,500 off on their tax return. Whoever files first wins that first battle. And then the person that didn't is unhappy and may have to file an amended return and talk to whoever it was that they were working with. All right, so you can't be claimed as a dependent. You can't use the married filing separate status. There's a limit on adjusted gross income, and they cannot be a non-resident alien. All right, they have to pay the expenses. So if somebody pays the expenses for them, that is treated as like they gave that person, the taxpayer, a gift, and then the taxpayer paid the school directly. So even if they didn't pay them themselves, somebody else did, that somebody else does not get any education credit. It's only that student or the person that claims them as a dependent. The American Opportunity Credit is the best. Basically, 40% of the credit is refundable. It's a maximum of $2,500. So that's where that $1,000 of refundable credit comes from. It's based on having up to $4,000 of qualifying expenses, 100% of the first $2,000, and then 25% of the next $2,000. So it's a big credit, it adds up. There are a couple of key criteria. So it can only be claimed for 4 tax years. You must be enrolled at least half-time as defined by the eligible institution. You only need to be enrolled for half-time on one term during the year. If you have a felony drug conviction, you are disqualified from claiming this credit. You cannot use married filing separate status. In addition to only claiming it for 4 tax years, it's also only available if you have not completed the first 4 years of post-secondary education. This can be an issue if people took college credit while they're in high school. It is also an issue for our non-resident alien students, right? So they come here, they're on an F visa, they're exempt. They're exempt for 5 years. So by the time they finally become a resident alien, they have passed that first 4 years of post-secondary education, and they're generally not going to be eligible for the American Opportunity Credit. Now, we do see people who come here for high school and then go to college. They become residents first year in in college, second year in college. They are definitely eligible. They get that credit, but it is not very common. It is much more common for them to not be eligible ever for the American Opportunity Credit. All right. I'm going to do this. This is that stuff that I just said. All right. So I'm going to say it again though, right? So generally this is one of the areas where our non-resident alien students get into the most trouble because they go use resident software. They say, oh yeah, nobody can claim me as a dependent. I'm going to college. And they get this $1,000 refundable credits that they're not eligible for, that they then would need to pay back with interest and penalties because they were not eligible for it. So this is where people fall into trouble most often when they file incorrectly. All right, that was the American Opportunity Credit. The Lifetime Learning Credit is a non-refundable credit. It is more flexible, but it does not give you cash back and it is not worth quite as much. So it covers both undergraduate and graduate courses to acquire or improve job skills. So you do not have to be a degree-seeking student. You can just take classes. The maximum credit is $2,000. It's calculated based as 20% of eligible expenses. So the first 20% of your first $10,000 of qualified expenses. You have to attend an eligible institution. The qualified expenses includes tuition and fees. It only includes books, though, if you buy them straight from the educational institution as a condition of enrollment. So the 4012 has like a bunch of good tables to compare these. Whenever you get into a situation where you're dealing with an education credit, go to that section. It'll help you parse the differences there. It is a per return credit. So expenses from multiple students can be combined to increase the qualified expenses to that $10,000 maximum. And again, you can be less than half time. So more flexible, but not as much money. You have to spend a lot more to get that money back, and it's not refundable. This is one of the places where residents can choose, right? Which one should I take? Should I do the American Opportunity? Should I do the Lifetime Learning? Which one is better? So generally, if they are eligible, the American Opportunity is going to give them more money back, right? It's a higher credit on less amounts of expenses, and some of it is refundable. If it doesn't apply, then Lifetime Learning Credit is probably the best option for them. All right. Tables, lots and lots of tables. I'm going to kind of jump through the determining expenses, basically the same sort of things that we've talked about. Go through this here. Again, only qualified education expenses, so not room and board, not transportation, not living expenses, that kind of stuff. Here's what a couple of examples look like on student accounts, right? So the UPass was a transportation pass, so you could get around campus and around the city. The student health plan benefit fee was student health insurance, is what that was. So those would not be eligible expenses for the education credits. Likewise, if we were looking at this here, you can see that they dropped a class, right? So that $29.52 of tuition, we can't count that because there was a subtraction on that. They dropped it right away. So we need to take that out. You can look at that. So I said that they don't net the numbers out. So here is an example of a 1098T where they had $9,900 of expenses, $53.60 of scholarships. So they had $45.40 of qualified education expenses. So on and so forth. We've already talked about this. Aria, goodness gracious, you went on and on and on. Here's an example where the scholarship is more than the qualified expenses, right? In this case, this is going to be a taxable scholarship, right? It gave him more money than what his expenses were. That was great. That happens. That's going to be income that you have to report. All right. Generally, well, basically, there can be some game playing with whether you report something as a scholarship and claim expenses to net it out as zero, or do you maybe not report all of your expenses and claim a scholarship as income? Although it doesn't sound intuitive, sometimes because of those credits, it can actually be advantageous to have some qualified expenses and to claim, for example, the American Opportunity credits. Generally, if somebody wants to play that game, they will just prepare their return in each of the different ways, and they can see the effect of that for them. All right. I'm going to do that. I'm going to skip over those because it's basically 8 o'clock and I'd like to try to get us close. All right. Okay. One more thing on this, right? So when a student is a dependent, we really want them to work with their parents or whoever can claim them as a dependent before they file their tax return. Just because if they do file their own tax return and then the parents try to file and find out that the student has already filed their own return, that's going to cause their parents a lot of challenges on their taxes, either filing a different return or amending returns. So we would want to encourage people to at least have a conversation with their parents about that and what the consequences may be. All right. So if somebody has a scholarship or if they are dependent and they have over $2,600 of unearned income, there is a chance that they might have to file a Form 8615, which is basically, it's called a kiddie tax. Essentially, parents would give their kids stock so that it would be below the standard deduction and they could get like $10,000 of income and not have to pay any taxes on it. There are lots of stories of US citizens playing games to try to minimize the tax they owe, and then the government changing the rules to cut off that way of not paying so much tax. So if the dependent has more than $2,600 of unearned income, including taxable scholarship income, then do they file a tax return? They may need to file that Form 8615. It is out of scope for us. We don't talk about how to do that. It is generally not common. There are some additional criteria that unearned income has to be more than $1,300 if you take out the taxable scholarships. Their earned income has to be more than the standard deduction. And then there's a gross income number as well. So it's not very common to see that, but it is theoretically possible. If we ever did, we're going to back away slowly. It is not what we're going to work on. All right, so in summary, basically, there are 2 education credits, American Opportunity, Lifetime Learning. Generally, American Opportunity is going to be better if you have expenses over $4,000 and you're eligible, that's the one that you're going to take. Sometimes you can choose to report a taxable scholarship and then also report education expenses of $4,000 to claim that credit, and that might be the best thing kind of from an overall perspective. Taxable scholarships that exceed the qualified expenses are going to be reported as income. There we go. All right, so let's talk about finishing the return. I'm going to try to blaze through this here and get us out hopefully in the next 10 to 15 minutes. All right, so at a traditional VITA site, if you are finishing the return, right, you would have gotten the form 13614, which is the intake form. You would have had all the documents, you would have talked with the client, you would have typed it all into the return. You would then go back, you would double check everything to make sure it's all entered. You would have a quality review with another VITA volunteer. You would talk about whether you're getting a refund, whether you owe money, how is that going to come or go. You are going to print copies, you're going to sign return authorization forms, you're going to e-file the return. As an FSA clinic, we get to kind of skip a bunch of those things, right? The taxpayer doesn't have to fill out the intake form. They are the ones that are going to be entering their documents. We're going to encourage them to do that quality review though, right? We're going to look at their income documents. We're going to look at their finished return. We're going to say, yep, this all looks good. You've got all of your wages entered, got your other income entered. Here's your education credits information. That's all great. Taxpayer will do the refund or payment method information. Taxpayer is going to file it all on their own, right? So they are much more independent. They are the DIY, we are the help. If they are getting a refund, again, we're going to always encourage them to do direct deposit, right? The money comes a lot faster. Doesn't matter if you ever move. If they're getting the earned income tax credit or the additional child tax credit, that money does not get sent out until after February 15th. Basically, this is some additional time to give the IRS a chance to do a few extra checks. Make sure that they are eligible for those credits. There is an IRS website, there's an app where they can call to check on the status of their tax return. For the direct deposit, bank routing number, which is 9 digits, account number, which can be any number of digits, and then checking your savings. They really want to make sure this number is correct. They say several weeks, but it's not several weeks. It is several months for them to get their money back after that. So it is painful to do. It gets done, but it's just a bit of a pain. If they owe money, again, they can do the same thing for non-residents and residents, right? Direct debit, send a paper check, electronic payment options, credit cards, they charge those extra fees because they can't take less than the tax owed. They can also do an installment agreement. Again, interest and penalties do get charged, but like at least you have an official payment. When you file, your taxes are due, your return is due on the 15th of April. You can get an extension. Actually, I'm going to skip that. They owe a large amount of money, like a large amount, and they can't pay. We can refer people to a low-income tax clinic to get help with trying to negotiate with the IRS for the amount of money that they owe. Generally, if they do that, they're going to do things like look at your current income. They're going to look at your expected income in the future. So if you are here in school and you have very little income, they're going to say, yep, okay, you don't have very much income. But they're also going to look at this and say, yeah, but you're here getting a degree, right? And the expected income for that, typical wages for that are this much money. So we think you're going to be able to pay all of it or 50% of it or 10% of it or none of it based on that kind of a discussion. It is not a fast process. It takes like 1 to 2 years. But if it's a very large amount that they owe and they cannot absolutely pay it, then that may be a good option for them. All right, extensions. So people can request an extension. 4868 is the form that's used. That it grants them the time until October 15th to file their tax return. It does not give them extra time to pay. So that money is always due by April 15th. We still provide support through the software and through email through the end of October, so we can help them. We don't do appointments after filing deadline, but we still do provide support. If they do owe money, we would encourage them to pay as much as possible, just to reduce the amount of penalties and interest that they're going to owe. There's an online form that they can request for a payment agreement. Basically, depending on how much extra time they want, they will pay a little bit or pay more. When they do their tax return, generally there's also going to be a state tax return as well. The purple states are states where there is no income tax, state income tax. Everybody else has a state income tax. Washington State University is one of our partners out there. They don't have a state income tax, though they are close by Idaho and Oregon. So anybody that goes across the border would be owing state income tax there. We do support people in other states as well. that do and don't have income taxes due. All right. Yeah, I'm not going to say those. I'm going to do this really quickly. All right. If a taxpayer owes a lot of money, let's talk about prevention with them, right? So the W-4 is the form that they give their employer that says how much money they take out their paycheck. They can change that so that they have more money taken out every paycheck. They don't owe a huge amount of tax every year. If they have their own business, they have to make quarterly payments. They can send more money in. They can estimate during the year, send more money in. If they owe more than 1,000 for the federal government, the government will say that's too much. You should have paid more during the year. We're going to charge you some extra interest and penalties. If they're getting a really big refund, that's super cool, except you gave the government a free loan. They had your money all year, right? You want to have a little bit more of it back. Again, W-4 form, have less tax taken out. If they, well, we're doing residents. W-4, adjust the withholding so that the refund is smaller. They get more money every time they get paid. We're not going to do a lot of business stuff, so I'm not going to talk about that. But generally, if you own a business, good records are very, very important. Keeping track of all income, all expenses. Again, if they need help, like especially if there's a problem, if they get letters from the IRS, generally what we do is we say, have them email us. We'll do a first triage with that letter. We'll look at their original return. We'll look at their income documents. We'll do another quality review to make sure everything is correct. We'll look at what the letter says from the IRS, and we'll tell them, do we think that this is right? Do we think that this is not right? There were 2 students that I just helped with this a couple of weeks ago. They filed their tax returns. They never got their refunds. They got a letter from the IRS saying, no, actually, we think that you owe us lots of money. Please send us a couple $1,000s. I went through their forms. Everything looks good on their forms. I think we know why the IRS sent them this letter. And we basically referred them to the LITC for one and the Taxpayer Advocate Service for the other to say, look, you should get this money back. Here are some free resources to give you some help to make the IRS give you the money back. Essentially is what it is. All right, with that, it is 8:10. We're gonna wrap it up. Are there any questions about any of those things? I know that it gets very long by the end of the resident training, and I apologize. Okay, we're gonna skip this. We're gonna skip Iris. Yes, there are some fun. So if you get a chance, you want to go through the presentation again. Dear Iris, so IRIS, not IRS, is a fun kind of series of like Dear Abby letters that one of the volunteers puts together. Basically, I'll show you one of them. So right here, right? My boyfriend has 40,000, 45,000 in student loans, which he acquired getting his master's degree in basket weaving. I've been paying his student loans for him. You know, the IRS gave him this form, or the lender gave him this form. I actually paid this interest. Can I take this on my taxes? You know, and basically, we love you. I hope you love the guy, but sorry, you know, he's going to get to take it on his taxes. You do not get to do that. Hopefully, he'll take you out to a nice dinner to say thank you for all of that with the refund of your money. All right, so anyway, all right, really quick, Boodle. So there are modules 1 through 5, which were all quizzes. Hopefully everybody is mostly caught up with those. There are going to be 2 more or 3 more credits, and then education benefits are the next 2 quizzes. Those are up and live. Module 8, practice return assignments. That is not live. I need to go through them one more time and see where there are, if there are any issues in TaxSlayer before I turn you loose on them. Those should go live tomorrow for you to practice on, okay? Then the plan is going to be December 10th, we're going to take the foreign student test. December 11th, we're going to take the resident advanced test. So same things all apply, right? You don't have to take it with us. You can do it on your own. I haven't taken it yet, so I don't know if there are any bad questions. The VITA network that I'm at has not been screaming about the test, so probably it's pretty good. But we'll do the same process of resources. The 4012 is very much your friend when it comes to this. All right, with that, we're going to wrap it up. Thank you again for your patience.